What if the next $700 you spend could disappear in a weekend? Or become the first brick in a portfolio worth tens of thousands of dollars? Think about it. $700 can buy a new phone, a few dinners, a short trip, a bunch of things you'll probably forget about a year from now. But put that same $700 into the right long-term investment strategy. Reinvest the dividends and keep adding even small amounts of money. And suddenly, you're not just saving money. You're building an asset that can potentially pay you for years. But here's the part most beginners get wrong. Dividend investing isn't about finding a stock that pays the biggest dividend. A 10% yield can look incredible, right before the dividend gets cut and the stock falls apart. So in this video, we're starting from exactly $700. I'll show you how dividend investing actually works, how compounding turns small dividends into something much bigger, what beginners should look for in dividend stocks, why chasing high yields can destroy your portfolio, and how adding just a small amount consistently can completely change the outcome. And by the end, you'll understand something much more important than which stock to buy. You'll understand the system that can turn a small amount of money into a growing wealth-building machine. Let's start at zero. Before we talk about turning $700 into wealth, you need to understand what you're actually buying. When you buy a share of a public company, you become a tiny owner of that business. That company might sell products. It might provide software. It might own real estate. It might operate banks, factories, stores, or infrastructure. And when a profitable company has more cash than it needs for certain business purposes, management can decide to return some of that cash to shareholders. One way it does that is through a dividend. For example, imagine you own 10 shares of a company. The company pays $1 per share each year in dividends. You would receive $10. You didn't sell your shares. You didn't work another shift. You didn't create another product. You simply owned part of a business that distributed cash to its shareholders. That sounds powerful, but here's the reality check. $10 isn't going to make you rich. Neither is $100. Neither is $500. The real power isn't the first dividend. The power comes from what you do with it. And that's where the snowball begins. Let's say you invest your $700 into a diversified portfolio of dividend-paying investments. For illustration, imagine the portfolio produces a 4% annual dividend yield. That doesn't mean 4% is guaranteed. It simply gives us an easy example. 4% of $700 is $28 per year. So your first year might look something like this. You put in $700. The investment generates approximately $28 in dividends. Now you have a decision. You can take that $28 and spend it, or you can reinvest it. And if you reinvest it, that $28 buys additional shares. Those additional shares can potentially produce their own dividends. Then those dividends can buy more shares, and those shares can produce more dividends. That's compounding. It's money creating more money, which creates more money, which creates even more money. The first few years can feel painfully slow. That's normal. If your $700 generates $28 in year one, you're not going to feel like a millionaire. You might even look at your account and think, that's it! But compounding has a strange characteristic. It looks weak at the beginning and becomes increasingly powerful with time. Think about a snowball rolling down a hill. At the beginning, it's tiny. Then it picks up more snow, then more. Eventually, the snowball isn't growing because you're constantly adding snow yourself. It's growing because the snowball is collecting more snow as it moves. And that's what you're trying to create with dividend reinvesting. A self-reinforcing cycle. This is one of the most important lessons in investing. The beginning is boring. And boring is exactly where most people lose patience. Let's imagine your $700 investment grows at an average annual rate of 8% over a long period. Again, that's an illustration, not a promise. After 1 year, you're around $756. After 5 years, you're around $1,029. After 10 years, you're around $1,511. Now, look at that. 10 years, and your $700 didn't magically become $100,000. That sounds disappointing, but watch what happens when time keeps working. After 20 years, that same hypothetical $700 at 8% becomes roughly $3,260. After 30 years, it's roughly $7,050. Still not $100,000. And this reveals something incredibly important. The $700 isn't the wealth strategy by itself. Your real advantage is the combination of starting money, time, reinvested income, and consistent contributions. That's the part people miss. Your first $700 is the seed. It isn't supposed to be the entire forest. Now, let's change one thing. Instead of investing $700 and never touching the account again, you add just $1 per day. That's about $365 per year. Less than the cost of many subscriptions. Less than a few dollars a day. And suddenly, you're not relying entirely on your original $700. You're continuously feeding the snowball. Let's use the same hypothetical 8% annual return. Starting with $700 and adding roughly $365 per year, could grow to around $24,000 after 20 years and approximately $52,000 after 30 years, assuming the contributions are made consistently and the return compounds at that illustrative rate. Notice what's happening. The original $700 didn't do all the work. Your behavior did. And that's the lesson. You don't need to start rich. You need to start. Then you need a system that makes it easier to continue. And this is where dividend investing becomes especially interesting. Because instead of looking only at the stock price, you're also watching the cash distribution from the underlying businesses. Now, we need to talk about one of the biggest traps in dividend investing. The giant yield. You open a stock screener. You see one company paying 3%, another paying 5%. Then you find one paying 9%. And your brain immediately says, why wouldn't I buy the 9%? Because a high dividend yield doesn't automatically mean a great investment. Here's why. Dividend yield is calculated using the dividend relative to the stock price. So if a company's stock price crashes, while its dividend stays temporarily unchanged, the yield can suddenly look enormous. Imagine a company paying $5 a year in dividends. If the stock trades at $100, that's a 5% yield. But if the stock crashes to $50, that same $5 dividend now represents a 10% yield. It looks amazing, but what happened? The market just cut the value of your investment in half. And if the business is struggling badly enough, management may eventually reduce or eliminate the dividend. That's why experienced investors don't simply ask, how high is the yield? They ask, why is the yield this high? That's a completely different question. If you're evaluating a dividend stock, here are 5 things worth investigating. Number 1, dividend history. Has the company consistently paid dividends? Even better, has it consistently increased them? A long history doesn't guarantee future performance, but it gives you useful information about how management has treated shareholders. Number 2, payout ratio. The payout ratio tells you how much of the company's earnings are being distributed as dividends. Imagine a company earns $100 million and pays $40 million in dividends. That's a 40% payout ratio. Now imagine another company earns $100 million and pays $95 million. That leaves much less room for mistakes, reinvestment, or difficult years. A high payout isn't automatically bad, but you need to understand why it's high. Number 3, free cash flow. Profits matter. But cash matters too. A company needs real cash to consistently fund dividends. So investors often examine free cash flow to understand whether the business is actually generating enough cash after necessary spending. Number 4, business quality. Ask yourself, how does this company actually make money? Does it have a competitive advantage? Does it operate in an industry with long-term demand? Does it have manageable debt? Would customers still need its products 5 or 10 years from now? Because you're not buying a dividend, you're buying a business. The dividend is simply one way that business can return money to you. Number 5, valuation. Even an excellent company can become a bad investment if you pay an unreasonable price. That's another mistake beginners make. They find a fantastic business, then buy it at any price. Don't confuse a great company with a great price. Now we reach the question almost every beginner eventually asks: should you buy individual dividend stocks? Or just buy a diversified fund? Here's the honest answer. For many beginners, a diversified fund can be a simpler approach. One purchase can give you exposure to dozens or even hundreds of companies. That can reduce the damage from one company performing badly. For example, dividend-focused ETFs, such as SCHD, are designed to give investors exposure to a basket of dividend-paying US companies. But remember, an ETF isn't risk-free. It can fall. Its holdings can change. Its dividend can change. And past performance doesn't guarantee future results. Individual stocks give you more control, but they also give you more responsibility. If you own one company and that company suffers a major problem, your portfolio feels it immediately. If you own a diversified basket, one company generally has less impact. So don't choose individual stocks because someone on the internet told you that they're smarter. Choose based on your goals, risk tolerance, knowledge, and willingness to research. The best portfolio is one you can understand and stick with. Let's build a simple hypothetical example. You have $700. Instead of trying to predict which stock will become the next superstar, you could think in terms of diversification. For example, you might divide the money across several dividend-paying companies, or use a diversified dividend ETF. You could have exposure to consumer businesses, financial companies, healthcare, industrials, technology, real estate. Different sectors behave differently. That's important because you don't want your entire financial future depending on one industry. And here's another point that deserves attention. Dividend investing isn't necessarily about maximizing today's income. Sometimes the better question is, what could this dividend become? Imagine two companies. Company A pays a 7% yield but barely grows its dividend. Company B pays a 3% yield but has a strong history of increasing its dividend. Which is better? You can't answer that from yield alone. You have to look at the business, valuation, payout sustainability, growth, and risk. Because your goal isn't simply to collect the biggest check today. Your goal is to build an asset that can potentially grow over time. Now, let's return to the $700. Suppose your portfolio pays you $28 in dividends. You reinvest it. The next year, you receive dividends on your original shares, plus the additional shares purchased with those dividends. Then you reinvest again, and again, and again. Eventually, your dividend income can become meaningful. But there's another powerful factor. Dividend growth. Imagine your investment starts with a 3% yield. If the underlying company increases its dividend over time, your income from the shares you originally bought can rise too. That's why dividend investors often pay attention to companies with sustainable dividend growth. But again, nothing is guaranteed. A company can freeze its dividend, cut it, or eliminate it. That's why quality and diversification matter. And here's the biggest lesson from this entire video. It's not really about $700. It never was. The number is simply a starting point. The real advantage is the habit. If you learn how to invest $700 responsibly, you can learn how to invest $1,000, then $2,000, then $5,000, then $10,000. And if your income increases, your contribution can increase too. That's how wealth usually gets built. Not through one magical stock, not through one lucky trade, not through a guaranteed 10 times opportunity, but through a combination of time, compounding, consistent contributions, reinvested income, diversification, and patience. The boring stuff. The stuff nobody wants to hear about because it doesn't make a flashy headline. But boring strategies can become incredibly powerful when you give them decades. So if you're sitting there with $700 right now, don't immediately ask, what's the next stock that's going to explode? Ask better questions. How much risk can I actually handle? Do I have high-interest debt that should come first? Do I have an emergency fund? What type of account am I using? Am I diversified? Do I understand what I'm buying? Can I leave this money invested for years? And most importantly, can I keep investing after the first $700? Because the person who invests $700 once isn't necessarily building wealth. The person who starts with $700 then keeps contributing, keeps learning, keeps reinvesting, and stays disciplined through market ups and downs, has created something much more valuable. A system. So here's your challenge. Don't obsess over turning $700 into a fortune overnight. Instead, ask yourself, what could my $700 become if I give it time? Because the market doesn't reward you for being impatient. It rewards long-term ownership, disciplined behavior, and taking risk intelligently. And remember, $700 isn't the destination. It's the first brick. If this video helped you understand dividend investing, hit like, subscribe, and turn on notifications because in the next video, we're going to take this one step further and break down how beginners can build a dividend portfolio without making the most expensive mistakes. And before you leave, comment one number below. How much would you invest every month if you started today? $25, $50, $100, or $500? Your future portfolio starts with a decision. Maybe yours starts with $700